Welcome everybody to this webinar. I'm very excited to share with you a very interesting topic in the area of lending and risk management, and the name of our topic for our discussion today is best practices to prepare lenders for a post-COVID world. Yeah? So as we all know, COVID has had a dramatic impact on our economy, and it is here to stay. But the interesting thing is, while most lenders, about 95% of lenders, right? I have probably had in-depth discussions with at least 100 lenders in the last 1 year, right? Mostly across Asia, in India and Southeast Asia. And I would say about 95% of those lenders are spending most of their time recovering from the aftermath of COVID. So looking at how they can improve collections efficiency, improve originations that are dropping, responding to government regulations, and a lot of operational stuff. But interestingly, few lenders, so roughly about 5%, have quickly learned from COVID, and they're silently building out some very strong capabilities that will help them do well, not only fighting COVID, but also in better times. And that's what I wanted to share with you guys today. Ironically, these are not the biggest banks who have a lot of capital and have huge IT investments, because as we know, their biggest banks are traditionally the slowest ones as well. These are very smaller, mid-sized to small-sized lenders and banks, nimble players, about the same size as you all are, right? So I'm very excited to share with you what they're doing and how you all can operationalize some of these in the context of Southeast Asia emerging markets, right? And we have some constraints in our markets. We have mediocre bureau coverage. Our IT systems aren't as mature as Western Europe and the US. So in the context of our economy and our infra, what can we do? So let's a little bit about myself and my company. My name is Joydip Gupta. I look after the APAC region for Scienaptic. I've got about 22 to 24 years in various sectors doing analytics and risk, and spent a lot of time with fintech. Was also a consultant to a lot of fintech and banking companies. Our company, Scienaptic, is a US-based company. We're headquartered in New York. We have a very large office in India, in Bangalore, where I'm from, and it's from this office that we support all of our Asian markets. So let's jump in. The agenda of the agenda of this webinar today is the following. We'll discuss the why, the what, and the how. So the why is, why should you do all of the things that I'm going to be talking about, right? How is COVID impacting economy and therefore lending in Southeast Asian markets? Right? So we'll go through a few slides and talk about what COVID is doing in our side of the world and what does that mean for us. Then we'll talk about the what. What are the great lenders, these 5 to 10% of lenders? What are they doing so differently that are preparing them very well for post-COVID world? And then I want to spend the bulk of our time on the how, right? So great. So we've learned the top 3-4 things that they're doing. How do you operationalize that in your country, in your environment? So we'll talk a lot about the how. Okay. So let's jump into the why. We'll talk about how COVID is impacting lending in Southeast Asia. Okay, so this chart here shows the unemployment rate. And I've plotted in 4 countries here. The Thailand data is a little bit off. This is a study done by the World Economic Outlook, but they're very confident of the other 3 countries. But really, what you can see here is the unemployment rate, right? If you can see from 2005 steadily to 2020, the unemployment rates in all our countries are dropping. And I have left out some countries, but because the chart gets really busy, but it's the same trend. And then suddenly you see in 2020, it spikes up to almost where we were 15 years ago. So obviously, from an unemployment standpoint, COVID has had a serious shock to the economy. Right? But what does it mean for us as borrowers? What it means is that traditionally good borrowers may no longer have the ability to pay because their spouses have lost jobs, or if they're an SME. And by the way, in this entire document, I'm talking as much about SME lending as I am about consumer and retail lending. So if it's an SME and they're in certain industries, their businesses are down dramatically. So your models that you have built, your scorecards that you have built to score traditional borrowers may not work anymore because the good may not be good anymore. So what great lenders are doing is they're enhancing their risk scorecards to differentiate good versus risky customers. So we're going to talk a little bit later about how you can enhance your risk scorecards in a simple way and how you can then do more complicated enhancements. The second piece of insight that I wanted to share is that your non-performing, So the second piece of insight that I wanted to share is that your non-performing assets are very likely going to increase, right? Not a surprise to anybody. This was a study done by S&P Global. They did this study in April, in the beginning of COVID, and then again in October. Numbers aren't very different. What you can see on the left side is the impact of COVID on the non-performing assets, right? Which is basically the percentage of your assets that are delinquent. So for example, if you take a country like Singapore, about 1.5% of their assets were delinquent before the start of COVID. And since COVID, so this light orange bar is the impact of COVID. So the overall NPA has doubled, right? So significant impact. Some of the other countries, the impact may be less. If you look at Philippines, the impact is less. But then if you go to the right chart, this talks about the credit cost ratios, right? So in other words, what percentage of your portfolio are you as a banker putting as a loss provision, right? So you're basically yourself saying that, hey, I expect to make losses, more losses post-COVID. So if you look at the Philippines line, pre-COVID, the credit cost ratios was about 50 basis points. So in other words, about 0.5% of your overall 0.5% of your overall books were, you're saying you would make provisions for losses, and now it has doubled, right? So what does that mean? What does that mean for us? This means that there are double the number of borrowers that you expect to make losses. So in this kind of a situation, it would be great to have, imagine a magical crystal ball that can tell you 3 months before what parts of your portfolio will default, what segments will become vulnerable, what customers will default, right? So, and that's exactly what these great lenders are building out. They're building out an early warning system that identifies early signs of financial stress. Okay? So we'll talk a little bit later about what are those leading indicators that you should be watching out for, and how can you put all of those together and build a system where the system automatically tells you that, hey, this customer or this segment is going to default, and then you can do something about it. Next comment that I wanted to make, and it's not a surprise to anybody, is that the future is going to be unpredictable. But what was really shocking to me is how unpredictable it could become, right? This is a study done by experts, so McKinsey and OECD. What they did is they sat down country by country and looked at GDP growth. So all of these bars are GDP growth. Again, if you look at a country like, let's say, Vietnam, right? The GDP growth percentage plan before COVID for the year 2020 was 6.7% growth, right? Now, as COVID struck, these guys went and studied everybody and said, okay, what is our expectation of how much GDP will be? They said it could be anywhere, it'll be less than 6.7 in 2020, but it could be anywhere from 1.9 to 5, right? Which is a huge delta, right? In Philippines, it's minus 0.3 to 4.2. So they have no clue, right? Even the experts have no clue. They're saying 2021 will be far better. And I think these numbers are very optimistic if you look at some of the other studies that have been done. But again, it could be anywhere between 4.9 to 9.8. So the future is going to be very unpredictable. No matter what models you have and how well you make them out to be, they will not be optimal. So what are good lenders doing to tackle such situations? They're going out and building out an environment that allows them to very quickly test and learn as the situation evolves. They're going to run some experiments. They're going to wait for 3 months to see how those experiments work, and they're going to change some parameters and run it again. Obviously, all of y'all can do these experiments manually, but it takes weeks and months for your analysts to kind of set something up and run. So what these great banks are doing is investing in tools and technology, either building it on their own or buying it from outside, which allows them to test and learn at push of a button. Okay, so times are tough, but it is during these tough times that some businesses innovate the best, right? When times are good, we're fat and happy. But if you innovate right now, it leads you to even greater heights when the economy turns around. So everything I'm going to tell you right now is not just for the COVID period. We are very, very sure that from seeing what these few companies are doing, that it's going to last them, actually give them much better returns post-COVID, right? I know you're in tough budget situations, investing in technology is tough, but I would really urge you to look at the next few slides and see which ones of these you might want to invest in-house and build something up. So to summarize, so this is the what, right? How are great lenders preparing themselves? One, they are investing in AI models. So they're improving their models and then making a slowly switch to AI because AI models are much better than traditional models. And then they're looking at alternate data. So unfortunately, in most of our countries, most customers are not on bureau and they don't have a lot of documentation. So what are some of these alternate data streams that can help us get a much better customer 360-degree information? We'll talk about that in the later slides, but this is exactly what these 5% of the companies are investing in. The second thing that they're doing is they're investing in a test and learn environment, right? What is a test and learn environment? As I mentioned before, it's an analytical environment to run rapid experiments and identify which strategies work best for which segments. And then if it doesn't work best, change it and run it again. So they're investing in technology and platforms that allow them to test and learn because the future is going to be unpredictable. And then the third thing that they're doing, which we're going to talk about in detail, is they're investing heavily in early warning systems because they have realized that if they knew about COVID 3 months before COVID actually struck, then they could have saved a lot of losses. And so what is an early warning system? It's a combination of models and scorecards, processes to handle the output of these models, and then dashboards that you can look at weekly, real-time, weekly, monthly, quarterly, that focus on leading indicators of stress before borrowers default. Okay, so the rest of this deck, we're going to talk about how, kind of double click into each one of these and talk about how you can kind of build these out. But before we do that, I want to do something a little more interesting. I want to do an audience poll, right? So I want to ask all of you people to look at your screen, and you will see a set of questions. Okay, you'll see a set of questions. I'll go through these questions with you slowly, and as I go through it, I'd ask that you please answer to the best of your knowledge. There are 4 questions. The first one, it says, do you think that your scorecards, policies, rules developed pre-COVID are doing well in a post-COVID world? Please take 5 seconds and please give your answers. Absolutely, somewhat, needs updating, or we have updated post-COVID. Okay. At the end of this, all your questions are anonymous, all your responses are anonymous, so we won't know who answered what, but I can look at a summary at the end of this session. The second question is, does your credit risk toolkit allow agile experimentation? So we talked about test and learn. Does your risk toolkit today allow testing and learning as new information or data becomes available? Yes, it is very adaptive, partially. It needs change. Okay, so I'll go ahead. I will have this poll open for about 4 or 5 more minutes, so you can, as I keep going through the rest of my slides, you can still have a question, time to look at it. Question number 3, do you have an early warning indicator system in place? Yes, and I'm very happy with it. Yes, but it's not very reliable. No, it needs to be built. And then the last question is, what's most important to your portfolio objectives near term? Want a smarter originations, better account management, which is portfolio management, better collections efficiency. So please go ahead, take a minute. If you have already done polling, if you want, you can use the Q&A button at the bottom to submit any questions. We'll give everybody another maybe 5 seconds, and then we'll be on our way. Okay, let's keep moving. We'll come back and I'll share with you the poll results. But I think from what I'm seeing right now, and I'm able to see some of the answers that are coming, not the individual answers, but the overall aggregates. I think there is certainly an opportunity for all of us in the audience to go through and listen to what, everybody's not delighted at what they have in terms of best practices. So let's go through the rest of the slides and see what we can learn. Okay, so first we said we're going to talk about alternate data and improving your models. So what are the alternate data sources that these companies are investing in? Traditionally, most of us rely on bureau scores. And unfortunately, bureau scores are not going to be effective in the short to medium term. Why? Because in most of our countries, the government has intervened to alter the natural credit cycle, right? They've given moratoriums, they've given other, parole to both SME as well as individual lenders. And you know that the bureau is going to be less effective during the moratorium, right? So people don't pay, the bureau doesn't know whether they're actually risky or they're just enjoying the benefits of what the government has given to them. And also, once the moratorium lifts, there will be a period of time. The bureau has a lag, right, in reporting. So banks will have to, wait for people to default and then report it to the bureau, and then bureau will take another few months to aggregate it. So over the next 6 to 9 months, bureau scores will not be very reliable, and we know that 50% of our borrowers are not on bureau to begin with. So what are the alternate data sources that might be useful for you all? I've bucketed them into 3 categories, right? The first one is internal customer data. There is actually a lot of customer data internally available to you that typically our lenders don't look at. Employment information is fun, right? So if you have CASA accounts, if you're a bank who also has current accounts, saving accounts of your customers, you have a lot of extra information on employment, but otherwise, you can have this information or can get it from customers, right? Payment history pre-COVID. So pre-COVID, if certain customers are absolutely spotless in their payment history, then chances are they'll protect their payment even post-COVID. But the customers that have been a little spotty pre-COVID are more probable to become really, really spotty post-COVID because they don't care that much about maintaining a clean bureau record. Collections logs. So collections logs is basically a record of all the interactions from your CRM system or from your call center system. So, if a customer was paying on time earlier and then, or just needed one small push, and now you're seeing that he has to have 2 or 3 reminders, and maybe in the last month, he's actually you're needing to make calls out to him, you can know that stress is building up, right? So a lot of information is there about how your customers' behaviors are changing. The second set of data is information you can get directly from your borrowers. None of these are very, very new, I hope. Salary slips for salaried accounts, salaried customers, bank statement, financial statements. Now, one thing I will call out is every one of you uses bank and financial statements, certainly for SME lending, right? Even for consumer lending. I think what these banks, these top 5 lending institutions are doing differently is they have automated this entire process, right? So imagine somebody pops in a bank statement, and within a few seconds, that PDF document is parsed into an Excel-like format, right? Within another few milliseconds, new variables are created out of those bank statements, new ratios and variables that are required for risk analysis. And then in another second, it's passed through a scorecard. So the moment a customer pops in a bank statement, within a minute, you know what is his risk based on his bank statement alone, right? Same thing for financial statements. They're fully automating this process, right? The last one is relevant in some countries, phone text messages from financial institutions. I know in some Asian countries, the banks and the financial institutions give confirmation messages saying, hey, you withdrew $2,000 from the ATM, your current balance in your account is this, or you made a payment on your credit card or on your Amazon Pay or Google Pay wallet. If your country, if that's prevalent in your country, then a lot can be done by scraping the customer's SMS messages, obviously with consent from the customer, and creating new ratios and variables that give you a pretty good indicative read on the customer's financial, his inflows and outflows. And the third set of data is what you can obtain from third-party sources. There are countries where the government allows an API connectivity to the income tax bureau, so you can not rely on what the person says is his income, but get it from the bureau. For SME merchants, there are some companies who allow the VAT or GST returns data to be fetched electronically. That tells you real information about how their revenues have been and how much taxes they've been paying. Other alternate data include telecom utility bills. A very interesting phenomenon that has become very, very popular in the last 1 year is partnerships that lenders are making with large e-commerce companies, FMCG companies, and POS instrument providers, particularly to lending to SMEs, right? So you partner with Procter & Gamble, or you partner with Amazon in your country, and you then lend to their merchants, right? You have a lot of data that you can get from your partner around the daily, weekly, monthly cost and revenues that these merchants are making, and basis that you have a lot of reliable alternate data to make. So that's the slide I had on alternate data. Let's move to, I'll quickly move through this, and then we'll save some time for questions at the end. So let's move through the risk model adjustments. So there are two, I've broken it down into 2 buckets. One is simple adjustments that you can make to your risk models. Okay, you identify critical indicators of COVID impact, right? For example, we know that COVID has had a disproportionate impact on certain industries. If you look at this chart, this is a global chart by Roland Berger. The x-axis talks about, these are all industry segments. The x-axis talks about the liquidity impact short term, and the y-axis is profitability impact, right? Now, basically what this says is, if you look at this quadrant in orange, these are industries that have been impacted most by COVID. Versus if you look at pharma and health tech, they have had a negligible impact. So if COVID impact is, or industry is one of the dimensions that you pick up, then what could you do by looking at the industry? So, if you're lending to a consumer, you can ask him, what industry is your company in? If you're lending to an SME, you can find out what industry the SME is in. And then basis that, what you can do is you can overlay a risk multiplier to your existing models for borrowers working in certain industries. So you have your existing PD model, probability of default model. If the person is working or the SME is in supporting healthcare and pharma, then do nothing, right? You just multiply it by 1, nothing. If they're working in retail, which is somewhat impacted, you can multiply it by a factor of 50, 1.5. If they're working in tourism, double their PD. Now, it's not important what the factors are, that you can decide. But if you identify the top 2, 3, or 4 variables, one of which is industry, there might be 2 or 3 others. And we can, Scienaptic typically helps clients identifying some of those variables, but I'm sure you guys can do it yourselves as well. If you identify that, then overlay a multiplying factor on your existing scorecards, and you're done, right? That's a simple fix. But what these 5% of these companies are doing that I'm so excited about is they're using this opportunity to slowly move to AI. And from what I've, 95% of my clients in Southeast Asia have not really looked at AI in a considerable way. So they're scared. Okay, they're saying, okay, I want to do this. Let the economy become more certain, and then I'll do it. Unfortunately, this is the time when AI will help you most, and the economy is actually uncertain. Because what AI does is that allows you to more accurately predict risk using multiple internal and environmental macro variables, right? I don't want to talk a lot about how AI is better. I think if you want, we can probably do another webinar later on and going into depths about how AI is better and how you can use AI. But I just wanted to share one slide here on why, philosophically or conceptually, why is AI better than, why does machine learning or AI models work better than traditional regression models? Here are the top 3 reasons. The first one is your input and output variables will definitely have a lot of non-linear and multi-dimensional relationships, right? So all the X's and the capital Y that you're trying to predict, which is typically a parameter of default, 30 dB or bounds. They're not, one dimension. You can't plot them on a sheet of paper, right? They are 3-dimensional, 4-dimensional, n-dimensional interactions, which for a traditional regression or statistical techniques, very difficult to fathom. But AI does it really, really well. The second reason is tricky correlations among the input variables. So within the different X variables, they're not independent, right? As we know, a lot of macro environment factors determines your employment and so on. So AI is able to figure out the correlations between input variables, which is not possible to do manually or using traditional methods. And the third reason is there are hidden patterns in historical data. What AI is able to do is identify natural clusters and then define outliers within a cluster. So for example, if you have a credit card, you're using it to make certain types of transactions, certain amounts of transactions, certain times of the day in certain geographies. Now, if there is an anomaly transaction, AI is very quickly able to predict, find out that that's an outlier and say, okay, this guy is getting into stress, or maybe there's a fraud of some type. So AI is able to find all of them out. And then ultimately, what does it do? It basically puts all that, looks at your approved population, and then pulls out some risky customers, because AI is basically a much sharper knife for you to make these decisions. And using your traditional methods, you have approved certain customers, AI is able to pull out and say, nope, these are risky customers, they need to be rejected. So basically what happens is your portfolio quality improves, right? Unfortunately, what also happens is that you approve less, so your growth gets impacted. So therefore, what AI models do is then look at your rejected population and apply the same lens and find out how many customers in the rejected population are actually good, and you should approve them. And usually they're able to swap in more good customers than swap out bad customers. So net, your portfolio grows and becomes healthy. So we'll talk more about AI if you're interested, but really this is one of the things that very good institutions are charging ahead with. Next topic I wanted to cover is test and learn. So again, there's a lot of things that banks are doing around testing and learning and building up a test and learn environment. I'll cover the top 2 here. So the first one that's being used extensively is stress testing, right? So what does stress testing means? It's basically analyzing how different variables, input variables, impact performance of customer segments or subsegments, right? So basically you take top 3 or 4 variables, you simulate different scenarios, give it different values, and see what's the impact on approval rate and loss rate, right? Now again, all of us do this, but we do it very manually. And so if I give you 4 variables and 20 scenarios for each variable, it's going to take you months to do this. But what these 5% of these lenders are doing is investing in building out technologies which allowed you to do this at the push of a button and do it iteratively. And then once you have figured out a process, do it periodically, do it monthly and quarterly. So all your segments and do it particularly for vulnerable segments, right? You don't have to do it for your entire portfolio. So you're always in control. The second thing that they're doing is setting up a risk appetite framework, right? So models give you a certain probability of default, right? But only you know how much risk your business should be taking, right? And based on that, you set cutoffs, right? You do that today. But what if you had a tool that could very quickly allow you to say, okay, here are my 20 segments within my overall portfolio. Here are the bottom 5. I'm going to monitor them very closely, and I'm going to actually set cutoffs, different cutoffs, right? I have this segment. This segment is very profitable, so I can actually tolerate some more risk, right? This segment is not impacted by COVID. I'll tolerate more risk. However, this segment is really impacted by COVID. I want to actually set different cutoffs. And then you test and learn. You push a button, and then all of those get executed. And a month later, you'd say, okay, are my cutoffs working well? No, let me change it. Let me do some simulations and come back. So you can have variables from all of these different euro variables, geolocation variables to test your cutoffs. But again, these banks have invested and built tools that allow them to manage these cutoffs and expected performance over and over again, and kind of have institutionalized that in their portfolio quality review process. So there are a few other things that I'll briefly touch upon and on what these great lenders are doing to test and learn. I talked about vulnerable segments, so they don't focus on their entire portfolio. It's always 80-20. 20% of your segments and customers are going to give you 80% of the losses. So focus on those and do your simulations and test and learns only on those. They have a very easy simulation platform that they've built out. I'm amazed at how few of our clients have real-time performance dashboards. Even if you don't have a simulation environment, you do need very good dashboards. Excel doesn't work anymore, right? And there are so many of those dashboard tools out there available. Champion Challenger. So this is a technique that some of you guys probably already know about. Basically, if you have an approval strategy that's working or not working for you, right? Let's say that's the incumbent champion strategy. And then you're saying, well, what if I increased my bureau cutoff and try to see how that works? You don't know if that's going to work better, but you want to give it a shot. Let's say you have another conservative strategy and you're saying post-COVID, that might work better. How do you test all of these in parallel? Well, there are systems that allow you to actually roll out all of those strategies and models and scorecards in parallel. And randomly, you can allocate 90-95% of your applications through your champion strategy. So you're not betting your books, so to speak. But the other 2-3-5% you can allocate between different challengers. So month after month, you can actually see through your dashboards how the challengers are performing. And if they're performing better than expected, then you can slowly divert more traffic. Risk-based pricing and limit optimizations. Again, in this economy, it's very important that you don't reject customers if they're risky. You do go the extra mile and figure out if these customers, can you charge them more interest and still keep them? Are they still able to pay? Because if they are, you can actually price based on risk, get more money back from them, optimize limits right? So maybe they're high risk for $10,000 of loan, but if you give them 8,000, maybe they're okay. So why leave money on the table? So risk-based pricing and limit optimization are key items that these banks are using. And finally, the top reject reasons or the top risk reasons, right? So these guys have built out tools where every application that comes in, at the end, whether you approve that person, conditionally approve that, or reject that person, the system is able to figure out what are the top 3, 4, 5 variables that capture most of the risk of this individual borrower. Wouldn't that be great, right? So even if you're doing a manual underwriting, you don't have to look at all these documents, right? If you trust the system over time, and the system is running machine learning and other models, let's say, right? They're doing a much better job that you could manually do yourself. And so you only have to look at, okay, this guy his bank balance has dropped dramatically 3 months ago. That's one, and so on and so forth. So these banks are investing in tools and techniques and processes that allow them to do all this. Okay, so that's test and learn. Let me quickly move to the last item, which is early warning system. So again, I won't go into a lot of details, but I'll conceptually tell you what these lenders are doing from an early warning system standpoint. And what are those variables? So they're investing in smarter automated early warning systems, right? There are a few leading indicators that tell you 3 months, 4 months before a person actually defaults that this person is going to default. What are those indicators, right? Let's have a look. Again, I've bucketed them under 3 categories. The first one is the interaction data. This is the data that you can, again, get from your call logs, from your customer service, from your call center, from your collections teams. Average reminder calls before the person pays. Again, like I said earlier on, if a person needed only 1 SMS notification pre-COVID, post-COVID, he needs 2 or 3 emails, and then last month somebody had to actually call him. He still paid, but you know that stress is building up, right? Earlier, he was okay with just an SMS notification going to him or a mobile app alert going to him, but now somebody needs to send in emails. The interaction channel has changed, right? Reminder emails have changed, etc. So if you study trends in the interaction data, it can be very valuable for you to look at early stress building up. The second bucket is the performance of customers in your account, right? So in your account, how are your customers performing, right? Look at the last 2-3 months of payment behavior. Are there early delinquency metrics? Are they still paying, but they're not paying on time? They're paying a little bit behind time. Are they new customers? How long have they been on your book? Are they really new, or have they crossed the 2-year mark, right? So you can trust them more. What's if they're on credit card or line of credit? What's their utilization? Are they starting to utilize more and more of their credit line? Which means, and if they've never done that post-COVID, you know that early signs of stress are building up, right? So those are some of the variables, and there are about 10, 15 more that you can get from your own account performances. And then the third bucket is outside your account, right? Off-us performance. You can get data from the bureau, and a lot of our clients periodically pull in bureau information every quarter or every month on how are my existing customers doing outside of my books, right? How are their delinquencies across other products? What are the total number of accounts? What's their total utilization, et cetera, that you can get from the bureau, right? So you look at all of this information, but what these top 5-10% of the banks are doing is they're building a system by which they don't have to process all this information manually. So they are building behavioral AI models that have the ability to look at all of these, put the power of AI behind, and look at the permutations, combinations, nuances, the interrelationships, multivariate relationships between all of these, and are able to eject out a response that says, for every customer, where on a scale of 1 to 10 in terms of early risk does he fall in, right? Let's say 10 is the highest risk customers, right? And 1 is the really nice customers, right? That are all green, right? So these AI models and systems are able to digest all of this information and say, from an early warning system, this customer is really good or really bad or somewhere in the middle. And they're also able to give the top risk reasons, as I mentioned in my previous slide, right? Here are the top 3 reasons why I, Mr. AI model, feel that this guy is a 9 or 10 on 10. And then based on that, these banks look at the answers and then make a variety of decisions, right? I've listed a few of them. Obviously, this is not comprehensive. What can you do to mitigate the risk, right? Or if a person is really green, are there any revenue increase activities? So for example, if the person is 1, which means he's very low risk, is there an opportunity to cross-sell or upsell, top up his loan or increase his credit limit? But if a customer has some risk, you can look at, can I give him a little bit of a payment holiday? Can I increase his tenure so his monthly installment requirement drops and it becomes affordable? The AI models can tell you all of that, right? And say, okay, drop it, and below this point, he will become low risk. Can I restructure his loan? If it's really, really high risk, then what these banks are doing is not waiting for him to default or bounce, but it triggers early collections efforts. Okay. So that's a high level of what these banks are doing to build out a much smarter and more automated early warning system. So those are the three things. Before I wrap up, I just wanted to show you a slide that really what it says is all the things that I've said so far are not PowerPoint slides, right? They're real. So this is an example of a real client that adopted some of these techniques, and we were able to help them tremendously improve their business impact, right? So this is an SME lender in an emerging market country, and they were in the business of giving small ticket unsecured loans. Okay. This chart, the way to read it is, so the y-axis is approval rate, right? So out of every 100 applications, how many applications do you approve before and after? So as you go up on the y-axis, that's good because you're growing your portfolio. The x-axis is the loss rate, right? 30 DPD. This signifies how risky your portfolio is, right? As you go to the right, your portfolio becomes riskier. So left is good. So up and left is good. The client started off here. They had a 35% approval rate. That is, out of every 100 applications, they were only approving 35, which was actually not bad. Most of their competitors were doing that or less than that. And they had a 30 DPD of about 3.1%. We were able to move them to this curve. And so the way to read this curve is, if you, Mr. Client, after using the AI models and using the test and learn platform, if you're still okay with your current 30 DPD, but you want to grow fast post-COVID, then you move up. So here at this, if you go to this point, it's still 3.1% 30 DPD. So your losses have remained the same, but guess what? You're now approving more than half of your applications instead of only 1 out of 3. Or if you're happy with your current book size and you don't want to grow acceleratedly, you can look at reducing your portfolio bad rate. So your 3.1 becomes 2.3 without dropping your book size, right? So you get a 80 basis point reduction in your 30 DPD, which is huge, which was huge at least for this client. Or you can choose to be anywhere in this continuum, right? So this is the trade-off curve between growth and risk. So we were able to move this client from here to here, right? Now, one caveat, this doesn't happen overnight, right? This needs at least 9 months, sometimes 12 months, sometimes longer, right? So with this particular client, we moved them over to alternate data and AI models, and then set them up on the test and learn strategy. And it took a lot of hand-holding for 6 months. I know Scienaptic had to spend a lot of time helping this client. No client needs to do everything, right? So you figure out what works, what doesn't work. Every month have a review mechanism. And after 6 to 9 months, they started seeing the results, right? So this takes time. But I think what these great banks are doing is realizing that it takes a couple of years to get here. So they're starting right now. They're saving a little bit of their IT investment dollars to invest in these tools. And then 2 years later, when COVID impact goes away, they'll be in a far, far better shape than the other 95%. So if you even do half of the things that I have covered in my slides, rest assured, among your competition, you'll be in the top 5 to 10%. So let me stop with that. So this is my last slide, really recapping what we talked about in terms of takeaways. This is the first one was AI models or better models, eventually transitioning over to AI, and alternate data, using alternate data. The second one is really building out an environment that allows you to run experiments and test and learn. And then the third one is early warning systems. Okay. So let me stop here. I'm at the end of my presentation. We can take some questions. I also wanted to share with you the poll results. So let's quickly look at the results. Let me end the polling. And I'm sharing the results. You can see on your screen. Let me know if you can't. So the first question was, do you think that your scorecards policies developed pre-COVID are doing well in a post-COVID world? 5% said yes. The majority of you have said either it needs updating or somewhat, or we have done some updates post-COVID. Now, typically, no one's sitting idle, right? COVID has come, 8 months have gone, right? Typically, what my clients, the typical reality is both of these last two, right? Which is what you guys have been telling. So we have updated post-COVID, but can it improve further? Absolutely. Question number 2, does your credit risk toolkit allow agile experimentation and testing and learning as new information or data become available? Yeah, typically I get 80% impartially, and that's what we're getting here as well. So 3 out of 4 people are saying, yeah, it does, but is it really best practice? Probably not. Are there a few things we could do better? Yes. And some of you guys have said, no, it doesn't. It's very, some of the really old LOS systems that have a business rule engine, they fall in the category of no needs change, because it's very difficult to change a few things, even if it's easy. So people typically do it outside of systems in Excel, and that really means they don't have a system. The third one is, do you have an early warning indicator system in place? 10% are saying, yes, I'm happy with it. The bulk of you are saying, no, it needs to be built out. And some of you are saying, yes, I have some aspects of it, but it's not very reliable. And that's exactly what I expect, because it's only post-COVID that people are really starting to think about, I wish I didn't have collections issues, right? I just wish I had this in place and I could quickly, change gears and say, okay, Mr. EWS, early warning system, tell me quickly what's going to happen 3 months later. And then finally, what's most important to your portfolio objectives? Smarter originations, better account management, and better collections efficiency. Yeah, we did this poll about 3 months ago, and 80% said better collections efficiency, right? I think the situation has slightly improved in most countries after that. People are starting to say, now let me go back and increase my originations. But I think, this is just more of why to improve your originations, or even to do better account management, to do all three, I think you need a subset of everything we talked about. But I think, again, this is very reasonable. I think people are moving now from collections to doing smarter originations. I think you need to build the right early warning systems so you don't have a collections efficiency problem in the future. Things go south. So that's what you guys responded. Now we've got I think 10 or 15 minutes left, 10 minutes left. I see some of you guys have asked a few questions. I'm going to answer some of them. Please feel free to ask more questions through the Q&A button. But let me answer the questions that I have received. Does Scienaptic have the experience in dealing with these issues in real life situations? And has Scienaptic built out solutions for customers? Yeah, we have. I think every customer's requirements are different. So we have some of these functions built out into our platform, but we often need to tweak it and customize it, spend a lot of time with our clients to understand their particular situation in their country, in their business, and kind of customize our product a little bit. So yes, we have. One of the examples that I just showed you earlier is a real example. Typically, what we do is we have some of the modules already built out, so you don't have to build everything from scratch. They accelerate you tremendously, but then we reconfigure it or customize it a little bit to suit your needs and then deploy. There's another one that just came in. Okay, a few came in. So shouldn't we have had these early warning indicators before the crisis hit? How will they help me in the next crisis versus just reacting now to the one that has already hit? Yeah, so I think this question, it's a good question. I think this question is around, for now that the crisis has hit, we're doing some reactionary measures. That's not the point, right? The point of what the things that I have at least shortlisted for this presentation are not quick things that you can do to help you in COVID and then the impact vanishes. In fact, you can't even implement it in the next 3 months, right? I mean, you can start implementing it, you won't see the results. these take time. This is like going to a gym, right? If you take a pill and lose 20 kilos of weight, there's side effects, and that doesn't last long. This is going to the gym and building out your muscle over a 9-month period. So we're not talking about a knee-jerk reaction just to mitigate the COVID. We're saying the COVID has taught us some very tough lessons of things that can happen. Let's use this opportunity to do things differently. And here are the top 3 things that I think, top 3 things that I showed that you could do differently, right? And those things are there to stay. Won't go away post-COVID. Benefits will be there to stay. With your example, does the process include any marketing strategies for first-time borrowers, or the increase in monthly approvals are with their current repeat borrower base? So I think if I understand this question, you're saying, are there different strategies for new acquisition customers, or are there different strategies for existing customers around increase in limits or increasing in approvals? Absolutely, very different strategies, right? Some of the underlying toolkits may be the same, right? But the AI models, for example, will be different. So for your new borrowers, you're going to use a very different set of information, right? If it's an SMB borrower, you're going to look at their financial statements, bank statements, but you can't keep asking them for those statements every month or every 3 months. You have to switch to different sources of data that are frictionless, right? Those things that I told you about, early warning systems, right? You can get bureau scrubs, you can look at their last 3 months of payment history. And based on that, you can build processes, models, and systems that can recommend a different limit or a different risk. You might say, okay, increase this guy's credit limit or line of credit, or reduce it, or increase his risk, or increase his percentage on his loan, or drop it. Those are all outcomes for existing borrowers. Yeah, I hope I understood this question right. If not, please write to us separately, and we'll be happy to get into a call and explain in the context of your business how it is. How do we get a recording? Yeah, I think we will be sending up, sorry, I don't think I have that on my screen here. We will be setting up this entire video recording on a URL on our website. If you need one, just shoot us an email. We'll be happy to answer any questions you send us through email, or if you want to see a recording, send us an email. We'll send you an URL with the link of the video. This whole session is getting recorded. Which alternative data is most effective based on your experience? Mobile data, telco data, social data? I'll give you the short answer in the interest of time, and this is only my perspective. We haven't found social data. It's very interesting, but we haven't found it to be very risk predictive, right? At least in the experiments that we've done with the clients we've worked with. Because some of them, it's interesting, right? So if you're lending to a company and you want to validate how many years he's been in business, if he's on LinkedIn, the company's on LinkedIn, you can do a quick check, or how many employees he has. But those are all validations. It doesn't give you a variable that's very risk predictive, or not too many. Telco data and mobile data are useful. I think it's not about which one is more useful. It's about they're both useful in different contexts, right? You can use telco data, but to find out more than just how much I'm paying, and it tells you what plan I have. If I have a huge data plan that has 4 users that are using lots of data, then you know that I'm an affluent customer, right? I've kids playing videos all the time on tablets and smartphones. If there is a utility data of companies, right, gives you a little bit of how the production intensity is in the company, how much energy are they spending, and if that's going down, you know that their production is coming down. So there are different pockets. Mobile data is mobile data. By mobile data, I mean if the payment data, right? If you're saying payment data, again, that's useful to the extent that it tells you a little bit, but your mobile payments is only 10% of your overall spend, right? So if you're saying, and people in some countries, the mobile operator won't cut away your phone if you don't pay in the within 15 days. So a lot of customers purposefully delay on the mobile payments, pay everything else. So sometimes it can give you a false read. But yeah, are there some variables that help you? Absolutely, there are some variables. Okay, there's a bunch of other questions I'm getting around risk-based pricing. I think the Michael, a 3-digit APR looked at negatively. Most people don't get this. Yeah, I think some of the topics that I've rushed through, right? Risk-based pricing, champion, challenger, etc. Some of these things need a lot of detail, right? I've just given you a high-level overview, but I think the best way to do this would be, we'll answer some of these questions that came in. There are about 6 or 7 that I'm not able to answer because of time. We'll send them out through emails. But I think we'd be more than happy to get on a quick 30-minute call with, get you on a call with our experts, depending on what your questions are, to walk through these in more detail. Okay. Okay, I'm seeing more questions come in. Look, I'm sorry, we're I think almost out of time here, and I want to be respectful and mindful of everybody else who's also attending in their time. But rest assured, we've captured all the questions, and I will go through all of them with my team and respond to you with the appropriate answers, and we'll give you an opportunity. We'll be delighted, actually, if you give us an opportunity to talk about your issues in more detail, and we'll be happy to help you with all the answers that we can that fits your particular requirement or particular nuance of your business. Okay, so thank you very much for your time. Like I said, this slide can be, we can send you this slide, or it will be posted on our internet, on our website, or we can email it to you. Please shoot us an email if you want to get the slide or a video recording, and we'll answer all your questions as well as soon as I have time to go through them. So with that, thank you very much for your time, ladies and gentlemen. Hope this was useful, and hope you're able to put some of these things in practice. And if you, like I said, even if you put half of them in practice, you'll be in the top 5%, undoubtedly, within your competition, based on the 100 or so data points that I personally have in this part of the world. Thank you very much. So I'm going to end my sharing and end the session here. Thank you very much for your time. Have a good day.